This is Scott Cooper, and I want to make just a few introductory remarks before we start with Corey. I think most all of you should know that we've been a ESOP-owned company since 1973, and SWA was actually one of the very first ESOP companies, at least in our field, on the West Coast. We became an ESOP-owned company when Pete Walker left the firm, and he was bought out, in essence, by the ESOP, by the Employee Stock Ownership Trust. The ESOP has been fundamental to our culture and our philosophy, and is relevant to our group practice philosophy and being a participatory kind of a company. And so it's core to who we are. We own ourselves. We own the company as employees. And Corey has been, for several years, a world leader actually in the ESOP movement. He is the founder of the National Center for Employee Ownership. Corey actually helped in developing the legislation for ESOPs in the country, and he's literally known around the world as one of, if not the top, one of the top experts on ESOPs and employee ownership generally. The thing I really admire about Corey is that he's not just an idealist, but he's a pragmatist. So I know he's a true believer in employee ownership, as I am, but he's also very practical in terms of, understanding the needs and intents of business, and being pragmatic and melding ESOP with the needs of businesses. We're very fortunate to have Corey on our ESOP committee. He's an outside member along with Ken Gooden, our corporate attorney, and he's been really extremely helpful and informative in helping to direct and give input to our ESOP. So I think you've all seen his bio, and I won't get into much more, but thank you very much for joining us, Corey, and please,
Thank
have
you.
at it.
But I really do appreciate the opportunity to do this. This is fun for me. And it's been very satisfying for me to be involved with SWA for many years on one level or another, but particularly in the last few years, more closely by being on the ESOP committee. I think SWA does embody a lot of what drew me to employee ownership, that sense of obligation to other people in your company, whether that's from fellow employees or it's from the owners or leaders of the company, that building a business is more about, as people often say, well, it's just business. We're firing you, but it doesn't mean we don't like you. It's just business. And it isn't just business, is it? Business is personal. Business is about a lot of the meaning that we have in our lives, the security we have in our lives, the relationships that we have in our lives. So there's a lot more to business than business. And one of the things that really attracted me and has drawn me to employee ownership ever since is, Scott was saying that you need to be both pragmatic and idealistic. One of the great things about employee ownership, it turns out, is that companies that think that way, that it's more than just about business. It's about relationships with people and obligations to people, that they actually perform better. They're more stable, they generate more employment, they're better for their employees, they're better for the people who sell to the ESOPs, and we'll go through some of those data later. Now, of course, the question here is, an ESOP good for you and SWA? So after all that, you're going to be very surprised that my answer is no. Not really. Obviously, the question sort of presupposes the answer here, but it's an honest answer. But I also want it to be an answer that you come to in your own way and decide, does this make sense for you, and why, and what do you get out of this? I want to just give you a little story before we get started here about where we've come with employee ownership. I started the center in my basement in Arlington, Virginia in 1981. And the Democrats had just lost control of the Senate, and I was working in the Senate, which means that the voters had fired me. And I had wanted to start this organization anyway. I got started a little faster than I had intended. And so I was desperately trying to get some members. So I was blindly calling attorneys who specialized in employment law, largely a waste of time. And I called one of the attorney's offices, and DC at the time was still a pretty southern city. And the lawyer wasn't there, and I said, "Can I leave a message?" And I said, "I'm with the National Center for Employee Ownership." And she said to me in all sincerity, "I didn't know people could still own employees." So I thought, well, there's a ways to go on this. So about 5 years later, we did have members, we did have income, we could pay me a salary, we even had some staff people. And I'd been invited to speak to a group of lawyers. And so we were kind of milling around beforehand. And somebody said, "Oh, what do you do?" And I said, "I work for the National Center for Employee Ownership." And he said to me, "We do something similar. We lease employees." So I thought, well, this is progress. But fortunately, employee ownership has come a long way since then. What is an ESOP? And it stands for an employee stock ownership plan. It's not a generic term. You could use it that way. But when those letters are capitalized, ESOP, it stands for something very specific under US law, under the Employee Retirement Income Security Act. A few of you may be old enough to remember back in the 1960s, early 70s, there was a lot of scandals around pension plans. Workers at Studebaker, for instance, who'd worked there much of their lives and then were told, "Well, sorry, you're fired, you lost your job, no pension for you," what they'd been counting on. And so Congress decided it was going to reform all of the laws that governed retirement plans, and it also they threw in health care plans and other kinds of employee benefit plans. And the basic idea behind ERISA was, look, employers, we're giving you a tax benefit for providing benefits. In return for those benefits and those tax benefits you're getting, we want to make sure that you follow some reasonable rules to make sure that these plans operate, in the language of the law, for the exclusive benefit of plan participants. The plan should be for the people in it, and not as a way for you to kind of manipulate taxes and other regulatory conditions so that you come out ahead at their expense. Simple proposition that's led to thousands of pages of statutes and regulations. The ESOP, it turned out, became part of ERISA partly by accident. We'll talk a little bit later about Louis Kelso, but he was looking for a vehicle. In Congress, if you want to pass particularly a tax law, but really almost any kind of law these days, the best way to do that is not to try to pass it on its own, but to get it attached to some other law that has to pass. So if there's a tax bill, like ERISA was basically tax legislation, that's going to move through Congress, and you have an idea, and you can attach it to the train that's leaving the station, you have a better chance of its becoming law, much better chance. There are 20-some thousand bills introduced into Congress every year, last time I checked, and there are a couple hundred that pass. So ERISA was the train leaving the station, and ESOPs, as we'll see, sort of could fit into this retirement plan framework. So that's how they became part of retirement law. Now you could argue that employee ownership really could stand on its own, that it could have its own set of laws for how companies could share ownership with employees. And arguably that would be better. There are some peculiarities and glitches as a result of this that make ESOPs more cumbersome than they might need to be. But this was the opportunity, and so that's why it's there. So the first thing that's notable about an ESOP, one of the real innovations in this, it may not seem that way to you now, But if you go outside of the US, for instance, and talk to people about employee ownership, this notion that you can have an employee ownership plan where employees don't buy stock it seems very odd. But ESOPs are set up that way. It's the company that sets up a trust, and it is designed to hold shares for the employees in the trust, and the company funds the trust by making contributions to it. And those contributions buy shares. The company can borrow money to buy shares, so the company would go out to a bank, for instance, and it would borrow money, and then it would loan that money to the ESOP, and the ESOP would take, let's say, $2 million that it borrowed, and it would buy 2 million shares from somebody who wanted to sell it who was an owner. Well, the ESOP doesn't have any money, so the company puts money into the plan each year, and the ESOP pays it off. It's very much like getting a mortgage on a house. Often it's used to buy out owners of closely held companies. About 70% of all ESOPs are used for that purpose, including here at SWA. And there are a lot of reasons for this. There are a lot of tax benefits. I'll talk very briefly about those. There are a lot of tax benefits that Congress provided to employee ownership plans and the companies that sponsor them. But it's not all about tax benefits. You know, people today, I think particularly people who get into their 60s, when they think about retiring, they think about it differently than they did some years ago. When Social Security was passed, the average life expectancy was 69, and now it's in the 80s. So people think about retirement in a very different way. A lot of people who retire want to retain a relationship with their company in some capacity. And even if they don't, it's really hard. I can speak, as someone who developed an organization. It would be devastating to think that you build this organization, you leave, you sell it to somebody else, and they completely change the culture and the legacy and the vision of the business you worked so hard to create. And sure, you want to get a good amount of money for selling what you worked so hard to build, but it isn't just about the money for a lot of these people. And often it's not even primarily about the money. So the stock goes into this trust. Think of it as a kind of bank account that's held collectively for all the people in it. Goes into this trust, and now you got to do something with these shares, right? You got a big, you got 4,000 shares and 100 employees. So how do you decide who gets what? So Congress had to come up with some rules. The business owners would have said, well, the rule that I would like is whoever I want to give it to, right? And if you ask the employees, they'd say, well, maybe we should all get the same, or something like that. So Congress had to come up with some compromise. As they did on all of these rules, the essential compromise is, how do we craft a rule that makes these plans sufficiently equitable and fair for the participants so that it's worth the taxpayer providing these very generous tax benefits, while at the same time not making those rules so strict that no business owner would want to set it up. That gets back to what Scott was saying about this trade-off between ideology and pragmatism. You can have a perfectly designed, highly democratic, totally equal company like a worker co-ops. There are several of those in the Bay Area. But you'll never have very many of them. Or you can have something that maybe is less philosophically pure, if indeed that's the particular purity you're aiming for, but that there's lots of people doing it, and doing it in ways that clearly provide tremendous benefits for employees, companies, and communities. So that was the trade-off that they made here. Was they say, okay, everybody who's worked at least a year has to be in the plan. If management, we agree you need some discretion, but you've got a year to fire people. But if you've kept them that long, they've got to be in the plan. You've got to allocate the pay based on relative compensation. So if we had 5 people and we had a payroll of $100,000 and I made 40 and you made 20, I get twice as much as you do. There's actually a limit on how much of the pay will count, though. Over $265,000 this year doesn't count. So if I make $500,000, when I do this relative pay calculation, I don't. But if I did make that much, then we could only count the 265. So they push it down a little bit. The employees get the shares when they leave, but first they have to vest. So this is like all other retirement plans that the company can say, here, but here with the condition that you've got to stay here long enough so that there's an incentive for you to stick around. And other employees aren't too unhappy about that, because what happens to the shares of people who don't vest is they get reallocated to everybody who's still there. So if I'm an employee, I really may not be that happy about somebody who comes in for 3 years and leaves and takes some shares. I want people to make the same commitment that I am. So when you leave, then the shares get distributed out to you. SWA's plan is actually more liberal than what the law requires. Under certain conditions, people will be paid sooner than what the law requires. And the law says if you leave other than for reasons of death, retirement, or disability, you can wait effectively 6 years before you start paying people, and then you pay them in installments over another 5 years. If it is death, retirement, or disability, it's 1 year and then installments for up to 5 years. But SWA's plan allows for some faster distributions for distribution amounts under a certain level. And then, of course, when you get the shares, they're very pretty. They're nice decoration. You get a nice little piece of paper that says you own this number of shares. But what you really want to do is sell them. And so you sell them back to the company. And by the way, the company has to buy them at fair market value. So what do we mean by that? It wouldn't be a good idea if the share price were set by the seller. Right? Because that would not work out very well. So Congress said you're going to have to come up with some way to determine the value of the company. We'll go into that a little bit later. So how many ESOPs are there? There are about 7,000 plans. Some of you may have seen a higher number. We just went through an elaborate, time-consuming recalculation. And it turned out there are a whole bunch of little teensy tiny plans with a few employees that looked like ESOPs, that really weren't. And it really doesn't make any difference in the real number, which is 14 million participants. All those plans had maybe 200,000 people altogether. 14 million participants, that's a lot of people. So ESOPs have become a significant part of the economy. They have about $1 trillion in assets. So it's a big part of the economy. About 1/3 of the ESOPs, as here, own 100% of the company. And one of the nice benefits that Congress bestowed on ESOPs is that if you're 100% ESOP and you're organized under a certain corporate law, called it S corporation, you don't have to pay any taxes. So,
Except slight state tax.
yeah, different states have, a franchise tax or a small tax, but you don't have to pay any federal income tax. And so that's obviously a huge advantage for companies that are employee-owned. And that's why you have so many 100% ESOPs. That was not the case until that law was passed in 1997. And 97% of ESOPs are in closely held companies like SWA. And some of them are as small as 10 or 20 employees. There's one in Alameda that has 4 and has an ESOP, very unusual. And they're as big as companies like Public Supermarkets, which is a majority employee-owned and has 155,000 employees. So where did the idea come from? It came from this guy, Louis Kelso. And he lived in the Bay Area. 1950s, he became convinced that as we move through the next decades, what was going to happen is that historically, every time that investment in capital went up, companies bought more machines and more technology, that workers got paid more. And the theory was that if I'm working on a machine that produces twice as many widgets as it did before, that I'm twice as productive as I was before, twice as valuable to the company. Maybe I have to have some greater skills now. And so my wages would go up. They wouldn't double, but they'd go up. And it always went up kind of in lockstep. Well, Kelso said that's going to change because the pace of investment in new technology and new capital is going to be so fast that labor is not going to be able to keep up. We're going to start replacing job categories altogether. We're going to start replacing the kinds of jobs that at relatively low education or skill levels, but hard work and dedication, would pay people good wages. So when Kelso was writing about half the nation's workforce was in manufacturing, today I think it's 11%. So a lot of those jobs got moved into lower paying service jobs. There's a whole category of the economy now, a fast growing part of it, that's the service economy of people servicing people with lots of money. So that was something that he foresaw. And he said, what are we going to do about this? Well, one thing we could do is we could say the government's going to have to solve this problem. It's going to have to create a much higher minimum wage. It's going to have to redistribute a lot of wealth through the tax system. And he didn't like that idea. He said, you know, that no matter what you think about it, the result of that is going to be it's going to slow down the economy. And besides, politically, you're never going to get much support for really dramatic change on that front because too many people are not going to want to pay the higher taxes to do those things. So if wages aren't going to keep up, where else can people get a second income? And his answer, of course, was that if the real wealth is being generated by ownership of businesses, that employees needed to be owners of businesses too. But that's not so easy, especially your wages are starting now to flatline. Your consumption needs always go up. You know, when I was growing up, we had 3 channels, and it was free. And we had 1 telephone. In fact, we had a party line. That's sort of a 4th channel of entertainment, I guess. So anyway, Kelso said, consumption needs go up, wages flatline, no money left to buy stock to become an owner. Now what do we do? So we need some way that we can make people owners without their having to pay for it. And the answer to that was to bribe business people with tax incentives to share ownership with employees. Now, they wouldn't pay for the whole cost, but he figured enough employers would say, gee, I'm going to get some tax benefits, so it's cheaper to do this. It's the kind of compensation I can pay to people. And if they're owners, they'll perform better, and so the company will make more money. We'll all come out ahead. That was the basic idea. Now, interestingly, when I was in Ripon, Wisconsin, I was a college professor for a couple years, and I was watching 60 Minutes, and I saw this guy Kelso interviewed with Paul Samuelson, who's a famous economist. And Paul Samuelson said Kelso was an amateur crank. And I believed it, because I didn't know who Kelso was, but I knew who Paul Samuelson was. And Samuelson said, that just ain't going to happen, what Kelso. You're not going to see wages stagnate. So that was 1973. Anybody know how many digits were in the Dow in 1973? 3. Now there are 5. The Dow was 300 to 700 during the 70s. Now it's almost 17,000. So if you own stuff over the last 40 years, you did quite well. What happened to wages? Anybody know what median wages are in inflation-adjusted dollars compared to the 1970s? Pretty much the same. And in the last 10 years, lower. So Kelso was right. So if we ignore that, he said, we're going to have big problems. There's going to be enormous social disaffection. We see that now. There's going to be a decrease in the legitimacy with which people view society and the government. And not only that, but it's going to cause economic problems. Because people aren't going to have the money to buy houses and send their kids to college and start businesses. The more and more wealth gets concentrated, the less efficient the economy will be. And there was just a big study done by S&P, not some left-wing crazies, but by S&P, saying that in fact the growing inequality in wealth and income in the United States is becoming a major drag on economic growth. Because the concentration of wealth, those people, they go out and they buy art or whatever, but there's not the velocity of money that comes from ordinary people spending money and buying stuff. And so this has become all the rage. There's a quote from S&P that the current level of income inequality is dampening GDP growth at a time when the world's biggest economy is struggling to recover from the Great Recession. This book is on a lot of people's coffee table, but probably not too many people read it, 700 and some pages. But it's a huge bestseller, despite its density. So Kelso came up with the idea of ESOPs, and we've talked a little bit about how that works. So what is it? So an ESOP is simply a way for a company to borrow money, to buy stock on behalf of the employees and repay it in pre-tax dollars. And pretty much all the rest is commentary. The first ESOP was created on the peninsula in 1957, but there was no law, so every plan you had to go to the IRS and say, is this okay? Can we do this? That was expensive and very time-consuming. SWA actually created its ESOP in 1973, so it was one of those because the law wasn't passed till 1974. So that's a pretty remarkable thing. And to have had an ESOP now for 41 years is even more remarkable. You're in a very small group of companies, like probably fewer than 10 or 20. So Russell Long is a powerful senator. He got convinced this was a good idea. And Long was powerful enough to convince other people in the Senate that if he liked the idea, they should go along with it. It didn't really matter what it was. He was so powerful that you wanted to do Russell Long favors. So the basic structure was set up in '74, and there have been additional tax incentives passed, I think 17, and that lasted through '97. Interestingly, we now see other countries looking at implementing this model. The privilege of going to the UK a couple years ago and meeting with their Treasury officials, and they've now just passed legislation partly modeled on this. So, is it good for employees what we've created here? The tax cost of this, by the way, is somewhere in the range of a couple $2 billion a year. So, in federal government tax cost terms, that's not real money. And to give you a comparison, for instance, $80 billion a year is spent by states in tax incentives to get companies to move from one state to another. No net new jobs. You see the battle about states wanting to get Tesla to relocate there. There's not going to be more or fewer jobs as a result of Tesla being in one place or another. But there's going to be a lot less tax income for whichever state ends up giving all those incentives to Tesla. So it's $80 billion. The average is about $100,000 per job to provide, whereas ESOPs are covering 14 million people, and you'll see in very beneficial ways, for $2 billion. and generating a whole lot more jobs. So one of the questions is, if it's, and this is one of the criticisms of ESOPs, is that, well, ESOPs aren't a very good retirement plan because they're too concentrated in one asset. And so companies shouldn't have ESOPs. They should have diversified retirement plans. Well, the ESOP community actually, by and large, agrees with that, as does SWA. And so it turns out that ESOP companies are actually more likely to have a secondary diversified retirement plan as comparable companies are to have any kind of retirement plan. So they're just more generous. More telling is that when you look at the asset accumulation in ESOPs over time, participants in ESOPs accumulate about 3 times the total retirement assets between their different retirement plans as comparable employees in comparable companies. So that's a big deal. And in most ESOP companies, as they mature, as here, some of the ESOP money is diversified. So you've got some diversity in the ESOP, plus you often, in fact, most often, have access to something like a 401k plan. And salaries are somewhat higher in ESOP companies. I was at a conference in DC some years ago of leading economists that somebody had put together talking about these issues. And at the outset, they all said, this can't be true. There's a guy named Richard Freeman, famous labor economist, and now a huge advocate of ESOPs. And he was one of those people. He said, you can't pay people all this extra money and still be competitive. Well, you could pay people all that extra money if the companies perform better. And actually, by the end of the conference, they were convinced that that was true. We'll see some data on that. So where does SWA come out in turn? And I think this is really important. First of all, the SWA contributes 10% of pay to the ESOP, more or less, each year. And the average, the median contribution is about 6 to 8% nationally. Secondly, you contribute 10% to the profit sharing plan each year. Now, if you look at comparable companies, look at typical private companies, they have a 401k plan. And the median contribution by the company to the 401k plan is about 4% of pay. But that's a little misleading because it's typically a match. So if I put in $10,000 into my 401k, maybe the company will match $5,000, give me $5,000. But if I'm a lower income person or I don't have the discretionary income to put money in, I get very little match or no match. So that amount is skewed towards higher income people. The profit sharing plan isn't a function of the 401k. So that you can see that that number is considerably more generous. So you add those two together and then you add the match to the 401k, you're looking at, even compared to other ESOP companies, a multiple of what the retirement benefit are. This is an extraordinarily strong retirement plan by any definition of the term. Another thing that is important about ESOPs is that it's really not just about the money. And this is one of the things that has really struck us over the years. And I talked a little bit about, from the seller's perspective, that it's not just about the money. It's about legacy and culture, community. But from the employee's standpoint, a lot of times companies ask me with new ESOPs or with new employees to the ESOP, they say, they just really don't get it. We talk to them about what a wonderful retirement plan this is and how much money we're contributing and how they can help the company, and they just don't relate to it. And my answer is, there's nothing surprising about that or even particularly disturbing about that. It's very difficult for people who go to work every day to think about how much money am I going to have when I retire? right? 10 years, 20 years, 30 years, whatever years down the road that is. That's really not a driver of your everyday behavior, unless you're a very peculiar person. So it's nice, it's security. You certainly want to factor that into your employment decision, but it's something that you might take a job for, and it's something you might keep a job for relative to other offers. It's not something that drives your behavior at work or that you relate to day. Almost nobody says, I think and act like an owner because I'm going to get this big nest egg when I retire. It's a piece of it, as we'll see. But it's not the driver. The driver is what happens in ESOP companies, not all of them, but the good ones, that makes it an ownership company. Daniel Pink, who's a big fan of ESOPs, he's a famous author on management, he says that motivation is a function of purpose, challenge, and autonomy. And when I read that the first time, I thought, that's it. You know, I've formulated these ideas in different ways, but never as well as that. In fact, that's what really drew me into ESOPs in the first place when I read about them. Is I thought work could be so much more rewarding and invigorating for people if you could go to work and it seemed like it mattered what you were doing. And it mattered didn't have to mean you were finding a cure for cancer. Mattered could mean that the people you work with are people that you like and you want to see them do well. Matter could mean that you have the ability to design beautiful landscaping and improve the scene environment that people, you know that that's tremendously important in people's emotional lives to have that kind of environment. So that's real purpose. Purpose can be that I want to be able to fulfill my own particular visions about what work means, what I can contribute, what my skills are. Challenge. Work is boring unless you feel it's a little bit maybe at the edge of your skills. Work can be too challenging, then it's frustrating. But work that doesn't push you at least a little bit is pretty tedious. And autonomy. Autonomy means that we have some ability to have a say about what we do at work, and that too is tremendously motivating. It's like kids. It's very difficult to motivate kids, to get kids to do stuff. Really, to be successful, what you want to do is create an environment in which the kids find what motivates them. And they can find a way to do it. And the same thing's true at work. So any company can do that, right? It doesn't have to be an ESOP company. But what the data show is that ESOP companies are much more likely to do these things. And for a number of reasons. One is if you say we're all owners, it's harder to treat people as if they're just employees. That's a tremendous driver of these cultural changes. The second is that the research, which we'll see, definitively shows that the companies that are strong on those things perform a lot better. And the ESOP community is fairly tight-knit. They go to the same conferences and read the same books. And they get motivated by the same peers who say, well, we did this and this really worked well, and so they go do that. Somebody said to me that they'd come to our conference and they had come from conferences from stock plan administrators who administer plans in big public companies, stock purchase plans and the like. And they said, those conferences are technical, they're interesting. Your conference is like an evangelical tent meeting where everybody's talking about, oh, isn't this, we did this and this is really cool. We got employees involved doing that and that was really neat. And that's true. And I think SWA embodies these three things quite well. So let's talk a little about why it matters that you're an ESOP regardless of what the financial benefits are. And the most important of these, the most obvious, and therefore perhaps not the one that you think of first, is that if you weren't an ESOP, you wouldn't be SWA. when I first got in this business, I would go talk to employees sometimes, and one of the questions that startled me was, well, why do we have to sell at all? Why can't we just keep doing what we're doing? And I thought, well, that's kind of obvious. But when I thought, well, people don't think about that. And when you say, well, your owner's 67 and ready to retire, and you got to do something. And then it strikes me, oh yeah, we do. We have to do something. And so the something is sell to somebody else, and somebody else can have a very different culture. So you wouldn't have your culture if it weren't for an ESOP. And so as we said, it's a much stronger rationale to manage this way. Now, still having said that, you hear people say, well, but you could still do all that stuff if you had owners who are committed enough to providing people with a psychological sense of ownership. You hear this a lot from management consultants. And I want to take them all to dinner. We're in a nice buffet, beautiful food, and they get to smell it, and they get to help pay for it through their work, and they get to soak up the atmosphere, but they can't eat because a sense of dinner should suffice. So what happens in companies that create this culture of ownership without a real reward at the end of the day is people start to feel manipulated, as they should because they are. Ultimately, they're doing this for somebody else's benefit. So is this good for companies? Lots and lots of research on this. And we won't bother with the second one, but these studies, the first bullet is mostly private companies. In fact, I think it's probably all private companies, various studies. And what they do is they say, let's take a company like SWA and compare it to other landscape architecture firms for a few years before it set up its ESOP and then a few years after. So if SWA was growing at 2% a year before the ESOP, relative, 2% per year faster than its competitors before the ESOP, how would it be doing relative to its competitors after the ESOP? And it turns out, if you were like average, it would be 4.5%. So there's a 2.5% increment resulting from employee ownership. And that applies to sales, employment, and productivity. It doesn't seem like a very small number, but when you add that up over 10 years, you're looking at 30% more growth than you would have had otherwise. So if it's such a neat idea, why don't more people do it? And part of it is that it's still not known that well. And the people who would be the transmitters of it, like accountants and business brokers, they often don't want their clients to do it because they don't know how to do it. Or financially, they'll make more money if they can sell the company to someone else. They'll get a commission. And if you arrange for an ESOP, you don't get any commissions. So there's a big problem with knowledge and understanding. It also seems complex. It is complex. And for some people, even though it might be great, if it's too complicated, they just don't want to do it. For companies that aren't selling out altogether, you think, well, why don't you just share ownership? It's such a, your company will grow, really happier. And the answer is that may be good for the company. Maybe the company, instead of being a $10 million company, would be a $12 million company. But if you'd rather own 100% of a $10 million company than 80% of a $12 million company. So it might be good for the company, but it's not good for you. It's hard to do it really well. If you're going to create an ownership culture, you have to spend a lot of time, a lot of effort. It can be frustrating. So it's not easy to create these cultures. In our country, we also have a cult of the CEO. You read about business and you read about CEOs. It's about we hired this CEO and that CEO and they changed everything. It's baloney. That with rare exceptions, companies are immensely more complicated in why they succeed than who's the CEO. But it's easy to personalize companies' success around an individual. And so they get paid enough money to buy small countries, and everybody else gets paid less and less because only the CEOs matter. When you think about what performance is in a company, employee involvement is squishy. You can talk about R&D expenditures or strategic acquisitions or layoffs to cut your profit, your costs. Those are hard numbers. They're easy for people to understand. Saying we're going to set up an employee involvement system to generate more commitment and ideas and autonomy amongst people, and that'll make us more productive, it just doesn't have the same resonance for investors. And finally, our culture has elements of both competitiveness and cooperation, but we lean towards competitiveness. An employee ownership it works best through cooperation. So I said we're going to talk a little about valuation, and this is obviously very important because this is how you determine what your price is worth. And if there were lots of people here, we would actually do this as an exercise, but since you're all over, it's going to be pretty difficult, so we'll do it as sort of thought experiment. So let's imagine we've got this racehorse, Harry, and he's 3 years old, and he has a few good years left, he's in good health. And he won $300,000 in prize money last year, but it cost $250,000 to maintain him. So he made $50,000, and presumably he can race for another several years. So what I want you to do, just think about this for a minute, is if you were going to buy Harry, what would you pay for him? So I'll give you a little bit of time to think about it, and then for the folks in this room, I'm going to put you on the spot, and I'm going to ask you what you'd offer for Harry.
I want an exact number.
I want an exact number.
Okay.
And if anybody wants to, you can submit those via whatever system you submit ideas in this, if you like as well. All right. So who wants to volunteer a number first?
I don't have a precise number, but I know how I calculate it. I mean, I want to get an interest rate. I mean, I want a rate of return that's equivalent to those cash flows over time, the $50,000 over time, at the present value of that.
Okay, so that's a good start. You're a rational investor and you want a return. Let's think about this. What would affect Harry's rate of return? What would affect his future earnings?
His health.
Right, so his health, he could break a leg. His winnings, what would affect his winnings? What might make his winnings go up or down other than his health?
Other competitors.
Other competitors? Well, that's probably health dying early. Other competitors, what else?
Jockey.
Right?
Popularity.
His personal popularity? Yeah, sometimes that happens. What about the industry overall? Would that? So if there's more or less interest in horse racing, the prize money gets bigger or smaller.
The bets that are placed on?
Yeah, what other people think about Harry's chances. What about the economy overall? Would that affect? It turns out actually in horse racing the relationship may be inverse. Gambling increases generally as the economy slows. So there are a bunch of factors that are going to affect Harry's rate of return. Now, so we've got health, we've got the uncertainty of other competition, we've got good or bad jockeys, we've got the fickleness of public opinion. That we can compare these things to companies, right? So a company's earnings can be affected by the employees who, whether they come or go. Are you able to maintain good people? By labor costs. The company's earnings are going to be affected by the perception that the public has about the quality of work you do. Some of which is clearly related to the quality of work you do, and some of which is purely idiosyncratic. Certainly the competition is going to affect you. Obviously the economy is going to affect you. Both the general economy and the specific economy in, say, the construction industry. The environment's going to affect. There could be changes in environmental regulations that could affect you positively or negatively. So all those things are risks. Now, and so just like Harry, businesses have comparable risks. Now, if we're a rational investor like Scott, what do we think about risk in terms of how much money we want Harry to, how much money we're willing to pay for Harry? What's the relationship? If we have bigger risks, how does that affect how much we pay for Harry?
Pay less.
We pay less. So if I pay $100,000 for Harry, what's my rate of return if he makes $50,000 a year? How fast do I earn it back?
2 years.
2 years. So I have a 50% rate of return. That's pretty good. But if I give you $500,000, that's a 10% rate of return. Is 10% good enough for Harry given his risks? How do you know that? How do you make that assessment that 10% is not good enough?
Well, because of all the risk factors that you've mentioned.
But in just a sort of abstract sense, how do you say 10% is the right amount or 30% is the right amount?
Investments.
Other investments, right. So when you're looking at Harry, we want to say, what else could we do with this money? And there are lots of things you could do with it. You could put it in a CD, you could put it in a mutual fund, you could put it in real estate, you could put it in stocks of individual companies. And as we went through that list, each of those things is riskier. So the riskiest thing you can do with your money is to put it in the stock of a single company in a single industry. You don't have diversity to cushion risk. If you're really big, you have less risk than you do if you're smaller. If you're publicly traded, you have less risk than if you're closely held because you have other investors who can cushion the blow. So the bigger the risk, the bigger the return we want. So this is what an ESOP appraisal firm is looking at. What they're saying is, okay, given the risk of owning SWA, how much would I be willing to pay? And typically they take a period of about 5 years. And for companies, private companies, it turns out that the rate of return investors are looking for is often in the range of 15 to 30% per year or more. And that's because it's risky to buy smaller companies in one business. So, and this is something it's not just a sort of intuition, it's something you can test based on rates of return for comparable investments that are gathered in all sorts of data banks from mergers and acquisition firms. So if Harry made $50,000 and we wanted a 20% rate of return, we'd pay $250,000 for Harry. And the same thing happens in a business. We look at your profits and we take a multiple of those profits and that determines value. Now there are some adjustments that are made. At SWA, for instance, you own this nice piece of real estate here and you could move to cheaper digs and realize some of that return on your balance sheet. So there's an adjustment for that. But the large majority of the value of SWA is determined by your profits. Now, because the rate of return people expect will vary from year to year. Sometimes you may have a great year and your stock price doesn't go up that much because other investments look more appealing and therefore people will put less money into this. Why does that matter? Well, this notion of the multiple is tremendously important as an owner. If you're a profit sharer and you all collectively figure out a way to save $100,000 in costs, and therefore it's $100,000 more in profit, then if you have a nice, generous company, you get 10% of that in profit, as you do here. So you get $10,000 back. But if you're an owner, that $100,000 in profit, if you have a 5 times multiple for your value, that $100,000 in profit is $500,000 in stock value. So that's the difference between being as an owner, you get a multiple of increases in profits, and as a profit share, you get a fraction. Now, of course, the opposite holds too. You get a multiple of losses. So there's more risk in being an owner, but there's a much bigger upside. Another way to think about this is that you have margins on your work, right? After you pay all the costs, there's an amount left that's profit. And it varies a lot in company to company, but it's typically not that much. You know, maybe 5 to 15%. 15% would be really, really high margins. So let's say the margins are 10% on every dollar in revenue that you generate. Well, if you want to generate $100,000 more profit, you would need $1 million more revenue. Or you would need to save $100,000. So employees have a big impact on the profitability of the company and therefore the performance. So just some of the basic mechanics that you're probably familiar with. You're eligible after a year. The allocations are based on relative pay. You vest over 6 years. You can start diversifying after 10 years in the plan and you've reached age 55. You can diversify 25%, then 5 years later 50%. You don't have to, but you have that option. Distributions are going to begin after you leave. And as I said, the time frame will depend on your particular circumstances. And you can roll the money into an IRA when you do leave, unless you're older than 70 and a half when you leave.
And then number 4 in our case means you can roll, by diversifying, you can roll out of the ESOP into the profit sharing plan. Just SWA stock into that, whatever you invest in your profit sharing plan.
Okay, so I've talked for a long time. I appreciate your patience on that. But what I really need to do is get some questions, concerns, comments. And I assume there's a way people can do that remotely.
But they were supposed to email me, so we can read them out.
Okay.
No one has yet, but maybe we just opened it up. So if people do want to address any questions, please email me, and then we will read out the question.
It's Robert speaking.
Yeah, RMOLOSSI@swagroup.com.
When I was in high school, I had an English teacher who'd say, nobody asked the first question, so I'll ask for the second. So what's the second question?
If you could change anything about our plan, if you were like a master or something, I mean, is there something that you would change?
Well, I'm in a lot of circumstances, it would be a different answer because I wouldn't affect your plan, right? But because I'm on your ESOP committee, I actually have the opportunity to do that. So there have been a couple of changes in the plan that we've talked about in the last few years that are designed to create a better balance with, if you have lots of cash. Some plans, as they get more mature, what happens is that the people who are senior have a lot of stock and a small amount of cash, but the people who are less senior tend to have the reverse because the company starts putting in more cash relative to stock over time for a lot of sort of. There's a way to solve that, and so SWA has these provisions in place now. So that was one thing I thought was important. Some of the we changed some of the distribution policies to provide a little more flexibility on that and faster distribution for some people. So I actually think your plan's in really good shape, but if I were coming from the outside, I might have I had more of an opportunity to actually do it. So I think you have a very well-structured plan.
Ashley Langworthy has a question, which are distributions taxed?
Sort of, yes. There are two ways that you can pay tax on a distribution. The first is that you take your distribution and you roll it into an IRA. So when you roll it into an IRA, it's just like any other retirement plan. Nothing happens from a tax standpoint. You don't start paying taxes till you take that money out. And then you pay taxes on that the same way that you would on any other income. So it's income tax. So in California, it could be as much as 33.9% if you make enough money. So that's a very efficient strategy for most people. But there's an option, which is that you don't roll it into the IRA for whatever reason. And then you're taxed on two elements. So one element is how much money did the company put into the plan for you? Now, they don't look at what happened to the value of that money. This piece is, well, we put in $2,000 this year and $4,000 this year, and you just add all that up, and that's taxed at ordinary income rates. And if you take that prior to normal retirement age, then you have to pay ordinary income tax plus 10% on that piece of it. So that's substantial. The rest of it is appreciation. So, okay, I got 10,000 shares and the company paid, let's say, $100,000 for those shares over all those years. But there was appreciation on those shares of another 100,000. So on that 100,000, you'd pay capital gains tax. So you'd pay 20% federal income tax plus whatever your applicable state tax is.
So you really want to roll over it into an IRA?
For most people, the only time when it does make sense, if you're in a state unlike California, it doesn't have a high tax on capital gains, and there's a lot of appreciation, you may be better off paying taxes now. But only if A, you have a tremendous amount of appreciation, and B, you're real disciplined. Because chances are you can take that money and spend it. You put it in your IRA, it's going to earn money tax deferred until you retire.
We have two more questions from Laguna. The first is, how many shares are there in SWA? And the second question is, how many additional shares are generated each year?
Scott can answer that question.
Yeah,
I can't.
There are 88,000 shares held in trust. We literally have not added shares for many, many years. So our contributions each year are in cash to the ESOP, and those funds are used to repurchase the shares of people when they leave. And then those shares are recirculated among all participants. So we literally have not added shares for probably a few decades.
Yeah, most companies, once they have bought out all the shares, there's usually not a reason to issue more shares. The company value is the same, but the pieces are divided into smaller pieces. You typically only issue more shares if you did something like acquire another company. You might issue more shares.
I think that may be all the questions we have.
I have a question.
Yeah.
So what's your take on the growth or lack of ESOP companies in the country, and what about architectural, engineering firms.
Yeah.
Any trend one way or
Yeah.
the other with all of that?
There's been modest, well, the pure number of ESOPs has been fairly steady for the last several years. The number of participants has grown substantially. There's a couple things going on. One is ESOP companies grow faster than other companies. And the second is there's a lot of acquisition activity. A lot of ESOP companies are buying other companies. There's one company called Feral Gas that's done 228 acquisitions. And Davy Tree, you may see Davy Tree trucks. Davy Tree's employee owned, and they've done 80 or 90 acquisitions. So these are companies that are becoming ESOPs by default. But for the reasons I mentioned earlier, there's a lot of resistance amongst business owners to doing ESOPs because of misunderstanding, complexity, and particularly their advisors telling them don't do it because it's not something that's good for their advisors. In the architect and engineering industry, there's a pretty significant penetration of ESOPs. Of all the industries, the two industries that have the biggest penetration are regional supermarket chains or local supermarket chains. I think that has to do with a lot that they're very rooted in community, and A&E firms. There's a consulting firm, for instance, we work with, and I went to their annual conference, and probably a third of the people of companies at that conference had an ESOP, and others were thinking about it. It fits really well in these firms because they tend to have a lot of partners. So the notion of employee ownership is less foreign to them. And mechanically, an ESOP works really well to buy shares as each partner wants to sell. Whereas if the other partners have to buy from one another, it's after-tax money and it's expensive. So an ESOP is a really good fit in A&E firms. You see a lot of that. If you look at the largest 100 employee-owned companies, for instance, A&E may be the single biggest category. It's either that or supermarkets. Yeah.
For those, understand when they retire, you know, the ESOP pay them over a period of 5 years or something like that.
Yeah.
And you're saying is that ideally from tax reasons is throw that into an IRA.
Right.
You cannot leave it the way it is, right?
Leave it in the ESOP?
Yeah. That's my first question.
Yeah.
Second question, would you take the money instead of rolling to IRA, let's say put it into something like a Vanguard?
Yeah. Well, the first question is, you cannot be forced to take an ESOP distribution. But you are not sensible not to take an ESOP distribution because you have control of the money if you do. And otherwise, it's invested probably because of the demands of how the ESOP takes what the ESOP can do with these accounts, which are segregated. So when you leave at SWA, you don't retain an ownership interest in SWA stock. It's moved into other investments and fairly conservatively invested. So you could do better than that. I mean, it needs to be conservatively invested because the ESOP the company wants to make sure the money's still there. You can have a somewhat different risk profile. So it doesn't make sense to leave it there. Secondly, is it better to put in the IRA or invest it in something? Well, if you go into an IRA, a typical IRA is going to allow you a variety of investments. So it's not like they're not like 401k plans where you maybe can choose 12 things. Most IRAs, you go to a broker and you can choose anything.
Yeah, with Vanguard, you can invest in all their options if you have it in an IRA.
So it's rarely the best strategy to, I mean, you may need the money. You know, maybe you just really need the money to pay for your kid's college or a down payment on a house, And so you take the money, you pay the taxes, but it's a big tax hit if you take the money rather than roll it into an IRA. So it's better to avoid the temptation if you can. And if it's a substantial amount of money, it's worth at least talking to somebody about an investment strategy. Hiring an investment advisor, they're going to charge you 1% or something. That's a pretty hefty chunk of your return. But talk to somebody who can at least tell you about what strategy should you follow, about what to invest in. And almost invariably the best advice is to invest in index funds with low fees. All of the research on investing says that the more decisions you make about your money, the worse you do, and that the biggest long-term factor in the performance of an investment portfolio is the fee the company charges you to manage your money. So you put in, selection of index funds with low fees. Vanguard's very good. In fact, it was John Bogle of Vanguard who really first convinced people of this idea that low fees and index funds are the way to go. Other questions? I think that, that's my email. You are more than welcome to email me anytime with any questions you have, or give me a call, and I'll get back to you as soon as we can. Well, thank you all for your patience. I hope this has been useful for you, and as I say, it's been a real pleasure to work with SWA and all the people here. I think you're a great company, and it's an honor to be involved with you. So thanks very much.